Alright, we're almost ready to see how cash stamping works and jump into some case studies. Before we do that, let's recall what we're trying to accomplish. We're acquiring an income-generating asset that will help us build additional wealth for the future. We're going to structure our principal residence so that we can use the cash flows from the rental to convert our home mortgage into a tax-deductible investment loan. This is going to allow us to reduce our taxes and keep more of our hard-earned money in our hands and not the government's, which helps us beat inflation and improve our lifestyle over time. And we're going to accomplish all of this without any additional cash inputs beyond our regular mortgage payment. Let's start with the mortgage structure, and then we can dive into the numbers. For this strategy to work, we need to set up a new multi-component mortgage on the principal residence with an investment line of credit attached to it. There are lots of mortgage products out there that might look like they work for this strategy. However, in reality, many of the products lack some of the features required to run the monthly cash flow cycle properly. It's vitally important that the investment line of credit is set up for auto readvance, which means the principal that gets paid down on the non-deductible mortgage automatically becomes available to draw from the investment line so that funds are available in a timely manner. If the structure doesn't have that readvanceable feature, it's going to cause friction and there will be implementation issues. This may seem complicated, but that's where our team comes in. We work closely with you to make sure you have the right structure in place, and we hold your hand to help get your cash flows going while you learn to implement the strategy. Now, the ultimate goal here is to pay down your non-deductible debt as fast as humanly possible. And the way we do that is by applying the rental income as a prepayment on the mortgage each month. Then reborrow that same amount from the investment line of credit to service the rental property expenses. Each month, we convert more and more of your mortgage over to the investment line, which results in increased tax refunds that you can use to pay down your mortgage even faster and accelerate your wealth-building efforts.
Here's how it works. We make our regular mortgage payment each month through the principal residence mortgage. The payments are set to come from the household bank account, same as before. Nothing changes. Then we have the rental property, the little orange house at the top of the screen. The monthly rental income is on the left. That's the money we get from the tenant. And the rental expenses over on the right, which include things like principal and interest payments, property taxes, condo fees, etc. The first thing that happens in the cash flow cycle each month is the tenant pays the rent. On the first of the month, we get a check or an e-transfer, however we like to collect it. Now, what most Canadians will do is deposit the income with the bank, likely an account dedicated for the rental, and then pay the expenses on the property from that same account. Which is fair, because we've all been taught to do it that way. Keep our rental cash flows separate from our personal cash flows. But when we do it this way, we miss a wonderful opportunity to create additional tax efficiency. Because there's actually no rule that says we need to use the rental income to pay our rental expenses. When we receive the income from the tenant, it's ours. We can do whatever we want with it. This takes a minute to get comfortable with, because the natural tendency is to use the rental income to pay the rental expenses. This just makes sense. But there's a better way to manage the cash flow. What we're going to do is use the rental income to pay off our non-deductible mortgage first. Because we don't get any tax benefits for carrying that mortgage. It's bad debt, so let's get rid of it. That's the first step. We make our regular mortgage payment, same as before, and we make an additional prepayment equal to the value of the monthly rent. The principal portion of our regular mortgage payment plus the full value of the prepayment goes directly to pay down our mortgage balance, and the equity immediately becomes available in the investment line of credit,
which we then draw back out to cover the rental expenses and run our landlord business. That's it. Every single month, we use the rental income to prepay our mortgage, and we borrow the funds to cover the rental expenses. That's cash damming. And once you get the hang of it, it's really quite straightforward.